Awesome. Namaskar. Welcome back to another live with Aditya Soma here. So, in this channel, we talk about real estate investing and financial freedom through real estate. So, today I have a special guest for you guys. Actually, two guests who are crushing it in the mortgage world, because right now there is a lot of noise out there about the interest rates going up and about how the interest rates impacting on the market. And there's a lot of questions many investors has about mortgages. So that's why I love to bring experts in who are doing very exceptionally well in their niche. So let me introduce you guys to Josh and Erin here, who are who own a mortgage business and have 18 plus agents, and purely focused on investor focused, helping hundreds of clients pretty much month over month. So uh, definitely cannot find a better people than Josh and Erin here to answer so many questions I have, and also a lot of you guys have. So um, Josh and Erin, thank you so much, guys, for taking time from your day, for your busy schedule, to uh, you know come on this live. So thank you so much.
Yeah, thanks for having us on. Appreciate it.
Yeah, so just to start with, just tell us about you guys, and I'll follow up with some questions that I have, and then we'll answer the questions that investors have along the way.
For sure, yeah.
Yeah, so I guess just a little quick little blurb other than what you kind of talked about there. But yeah, Josh and I, we two of the three owners of the Findlay Mortgage Team. We a couple years ago, it always throws me off time wise, but opened up Findlay Mortgage Team, and we really wanted to just cater to focusing on investors and helping them either get into their first property or take their first property to their 5 to 10 properties, and then those who are getting kind of tapped out in the residential space, find ways to be able to grow beyond that, get into commercial. We have a lot of clients who are getting into infill and doing some of their own development stuff. We've had quite a few agents get into the industrial, commercial, specifically into like the self-storage. We've kind of seen everyone branch off into their own unique little niche markets of investing. We've had the pleasure of watching a lot of investors grow from their first few properties to get into the multifamilies, and then those who were tapped out on the residential side get into some really nice commercial stuff. So it's been a great and very adventurous first year and a half of opening up the brokerage, and the Findlay Mortgage Team being its own little thing there. So
Yeah, awesome. Glad to hear. So Josh, what's your take? What's your side of story there?
Sure, yeah. So the same as Aaron, we built the Findlay Mortgage Team out of the idea of just helping investors scale their rental portfolio. There are very few options in the market, and when the bank says no, most people just take it as face value because it's all you've been taught is, when the bank tells you something, that is exactly what it is, and that's not quite the case. So when we got into it, we quickly realized that there is a ton of solutions that nobody talks about. So we wanted to come from a place of giving and a place of knowledge, and that's why we started creating content around different mortgage products and strategies and solutions. And that's essentially how we grew the Findlay Mortgage Team into what it is today. So we use different product solutions and capital to help our clients scale their portfolios. And those transactions then turn into relationships, and those relationships have now turned into something that's much bigger than what we initially thought. So we're very blessed to have the clients we do, and we love what we do every single day.
Yeah, man, awesome. I agree with you totally. This is such a blessing business to be in, and at the same time, you gotta be very creative, right? Especially on the mortgage side. So let me jump in with a very important question that I wanted to ask mortgage people, because hey, what's happening? Like, what do you guys see with these predictions on the interest rates, and what's currently um,
Sure.
on the what's your take on the market with these interest rates?
That is a very broad question for a very complicated answer, but I will try to explain it as best I
Sure.
can. So the government, well, there's a handful of factors that go into inflation, but essentially the government printed 40% of the current money supply in the last 12 months. On top of that, we're having supply chain issues, coming up back from COVID. The majority of the small businesses have been decimated. There's a lot of factors that go into inflation, but inflation is currently at an all-time high, decades high. We've never seen it before. And how you combat inflation, if you take a look at past history in the 70s and the 50s and how the government essentially took care of it previously, was you increase interest rates and inflation decreases over time. And currently right now, that's exactly what the Bank of Canada is trying to do, is they're trying to decrease inflation in the economy. And to do that, they need to increase rates. Now, we've been very spoiled over the last 2 years with essentially free money. So if you guys kind of forget the last 3 years and go back to normal times, interest rates were around 3.5% or 4%. Like that was normal. That's kind of a normal life people should get accustomed to. That is essentially where we're at right now. We're roughly at around 4.5% for a 5-year fixed conventional mortgage with a big 5 bank at the moment. It seems like it's Armageddon because we went from 0.99 to like 4.5%, but we're coming back to reality. Now, the sentiment around the Bank of Canada and what they're talking about is increasing it to further than what we're normally used to. So the bank, Tiff McCallan, which is the head of the Bank of Canada, he's come out and essentially said that to fight inflation, this isn't going to be something that's transitory. It's something that's going to take some time to deal with. So we're looking at about 2 years out from now. And what's going to happen is they have a band of acceptable range. And currently we're at 1%. So we've had a few interest rate hikes. We're at 1% on the Bank of Canada overnight lending rate. And that is essentially can go to 3%. So their band is between 1 and 3. So he said that there even might be a situation where we go above that band, which essentially means interest rates are going to increase possibly with 2% or more for the Bank of Canada overnight lending rate. And usually that translates into prime rate, which is the rate in which the financial institutions lend people money, increasing in tandem. So what people are kind of freaking out about is the fact that prime rate is going to be increasing, and we expect it to increase significantly over the next 12 to 24 months, just based off of the sentiment of the larger banks and the Bank of Canada. So that is like variable rate and how that's affecting the market. And so the actual fixed rate, that's based off the bond market. The bond market is pricing in a handful of things. It's pricing in geopolitical issues. It's pricing in our economy. It's pricing in, the fact that the Bank of Canada is very aggressive on fighting inflation. And currently right now it's at the 10-year bond is at 2.9. It just hit it today. And that's the first time it's hit it since roughly 2004. So it's been quite some time since our bond has hit that threshold. And all the lenders who offer these fixed rates, so the majority of B lenders and A lenders, they have been drastically increasing rates. So we can't keep up with where rates are at. So again, tonight rates are going to be increasing just where the bond is at. So there's a lot of movement right now in the market. It's a lot of uncertainty with investors as to what's happening with rates. It doesn't change really your strategy. If you are buying good real estate and you have a solid exit strategy, stick with what you know and what your strategy has outlined. So.
So again, that's a really deep information. It's a lot to digest, guys. I would suggest go back and rewatch this after the live. But let me just try to understand that even in layman terms. Like, so there is a projection of interest rates can go up by 2% in next 12 to 24 months, which means the payments. If I own a property, I can expect the payments go up by at least few hundred if it's a $500,000 property. So, being an investor, what can I expect? What kind of impact this can have on the market with the projections?
Yeah, I think a few things. One, if you haven't already locked into some sort of fixed rate that's, I'd say 3 years or longer, and you're in that variable, really start to dial in what does your cash flow model look like, and if you have the ability, most variables do, to be able to lock in, what does that look like, and what's kind of like your trigger rate to where you start to really lose that cash flow, and when would it really start to make sense for you to potentially just lock those rates in? Because Like Josh said, it is going to be going up. It's, maybe 6 months ago, it was speculation. Then we had our first 75 basis points of Bank of Canada overnight rate increase. And it's no longer speculation now, right? We're in the middle of it. It's going to be going up. I think they just came out the other week already. They've already confirmed at least another 50 basis points. It's going to be going up. So we're going to see it. It is going to be happening. It's no longer speculation. So I think now is a good time for everybody to really sit down, assess their portfolio, assess their cash flow model, and start to figure out, okay, which properties am I going to be okay with, another point and a half, if I have a variable on the increase, and which properties am I going to start to be underwater on, and what is kind of like our break even point, and really just start to have some numbers dialed out and some key points of concern and evaluating. And if you're in a fixed rate, you're going to be relatively safe, at least for whatever your remaining term is.
Mm-hmm.
But for those that are looking at in terms of like, what does that do, not necessarily for just your payments, but also in terms of the market. We saw it about a month ago now where they had that first 50 basis point rate hike. There was a 2-week period where kind of deer in the headlights, everything kind of slowed for a little bit. And we actually talked about it in one of our other live streams, and it kind of happened right afterwards. There was a quick slowing. Market got back to normal. Now they're talking about more rate hikes. And I think you're going to start to see and already have seen a little bit of just a slowing or a plateau on the market where things are on the market, but you're just not getting as many offers, and the offers aren't coming in as high. I've talked to quite a few people. I had a client just this past week who, was trying to sell his house to be able to get into a new one, and just didn't get the offers. I've had a couple other investors list some properties in London and, 35, 40 days on the market and just weren't getting the offers that they were expecting. So there's definitely been a direct effect on the market. And I think you're going to have a little bit of a slowing down come the summertime. I think there's going to be, there could be potential to start picking up some properties at a pretty good price. How many flips that we did last year, coming up into the 6 to 12 month mark, there's going to be people who are going to need to offload these, because taking a look at where rates were when they got into the property versus 6 to 12 months down the road, you've seen almost a 100% increase in the rates for some of these, especially on the variable side. That's going to impact people and their ability to be able to refinance out of these private mortgages. So there's going to be a group of people who are going to need to offload these properties. And, for those who are liquid, it could be a good opportunity to pick up properties at a decent price, compared to the last 6 to 8 months. So keep an eye out. I don't think, the market is resilient. You go back to 2008, you go back to 2009. If every time, we had something come up in the market died, we wouldn't be where we were today. We wouldn't have had the last 2 strong years. The market is cyclic. It recovers. It moves as the world and the economy moves forward. So, it's not a time of panic. It's a time of sit back, kind of reassess, make sure you're still in line with your goals, or do you need to change direction? And just some time to do some thinking and some consulting with some professionals and making sure that you're still on the right path and your goals still make sense.
Yeah, that's a great suggestion, because especially if you already own some properties, sitting down with a mortgage is the best thing to do, because just evaluate how much can you expect. Maybe can I fix some properties, make them fixed rate. That's fantastic. And I have seen the same thing happen in Windsor market. Last month I haven't seen that much of impact, but like in March, but in April and this month, we are definitely seeing the properties are staying longer, and there is more inventory coming into the market than the buyers. And there are properties, some of them are not getting even offers. So yeah, definitely there is a slowdown. Probably we can see that a stabilization, because the prices has gone up drastically compared to last year. Until February, it was up by 30%, and now it's down to 20%. So it's still up compared to last year, but yeah, it's the same thing what I'm seeing here. So let's take a quick question here from Think Rich. How can I benefit from the equity in my house? I want to buy a rental property in a couple of months.
How can you benefit? So equity essentially means you have value in your home. So if you were looking to purchase another property, and you have a direct use for the funds, and you want to use it, I would say refinance the property to pull out cash. It's going to be the cheapest carrying cost. So amortized debt is always cheaper than a home equity line of credit debt, and it looks like less of a liability on your next mortgage. So I would say if you are looking to make a purchase and you are going to use those funds, then refinance the property, take out some cash, and use those funds to buy another asset.
But how about the home equity line of credit?
Sure. So a home equity line of credit is a great tool to have in your, in your arsenal of weapons as an investor. But if you're looking to, if you have to restructure your debt to be able to purchase another property, from a carrying cost perspective, amortized debt is usually cheaper than home equity line of credit debt. Now, currently right now, most home equity lines of credit are prime plus 0.5. So prime is 3.2% right now. Plus 0.5, you're probably looking at 3.7%, which is going to be actually cheaper than what a fixed rate is going to be. Now, the issue is when you're looking to actually debt service the next property, meaning you want to go buy another property and we need to take a look at your application, the carrying cost on your home equity line of credit, we need to amortize that debt, meaning we used 5.25% over 25 years to create your payment of the balance of your home equity line of credit. So that looks or reflects higher on your application than it would just taking out a mortgage and using those funds directly to purchase another asset. So if you have a direct use for the funds, I highly recommend just taking amortized debt. It looks better and it helps you scale faster.
I always used to think, actually, even I didn't think from the mortgage agent point of view where you're doing an application. But my thought process was, what if I don't need the money right now? But I want to have access to my equity, so that HELOC will give me access. And maybe, the opportunity will come 6 months down the road or 1 year down the road. Until then, I don't have to pay the mortgage.
Yes.
Yeah, and everyone, again, it's real estate's interesting because everyone has their own strategy, right? There's different ways that you can go about things. Some investors like to have the immediate access to the cash. Some, don't want to have that immediate bump in monthly payment, so they will go the equity line of credit route. It comes down to you. It's same discussion as like fixed or variable. Everyone has their own preferences and how they want to go about things. There's advantages, disadvantages to both sides. Just making sure you're paying attention to the talks and things surrounding investment mortgages moving forward. There have been some talks about potentially not allowing equity lines of credits as down payment. So, nothing.
So is anything firm yet? Because someone was asking me the same question. Like, did banks already stopped using HELOC as a down payment?
No, nothing is for certain yet. It's all speculative. It's all just conversation pieces right now. But, it is just something to keep in mind, right? Moving forward, is it better to, potentially have that line of credit, or, again, trying to time the market with rates and whatnot. If you are going to refi, is it worth waiting 6 to 8 months till you find a property, given where the rates are going, or is it better to try to lock in something now?
Yeah.
So.
That actually leads to our next question from Kush. Should people wait to buy for some time, or maybe in June or July?
Let me whip out my crystal ball here.
June's coming up real quick. You got 25 days until June. So.
Kush, I promise you, if I knew that answer, I wouldn't be a mortgage broker, my friends. I think time in the market is always better than timing the market. If you have an appetite for an investment, you should buy good real estate. And the longer you're in that investment, the more profitable you're going to be. Deal with professionals like a good realtor or a good broker who can guide you through purchasing that asset, understand all the risks and benefits that come along with owning that property. I wouldn't necessarily be trying to time the market, because many men who are very, very smart have tried and they have not been able to do it.
Yeah. And actually that brings to another question that I have personally, because this is a common question I've been getting from my clients. How it gonna impact me when it comes to qualification? Because if I'm buying now, my interest rates are different. If I have to buy 4 months after, what are the potential impact that I can expect on my qualification?
Mm-hmm. Yeah. So right now, everyone qualifies 2 options. First is you're qualifying at the Bank of Canada rate of 5.25, which is the stress test, or depending on where your contract rate is, you're qualifying at 2% above that. So essentially anything that is 3.26 and above, you are qualifying at a higher interest rate than where the Bank of Canada stress test is going to be. Right now, if you're qualifying with a variable rate, you're still going to be qualifying just at that 5.25. But if you're qualifying at a 5-year fixed, like Scotia right now on a rental is 4.29. So you're qualifying at 6.29 for a 5-year fix. So comparatively, if you're taking a look at a 5-year fixed versus that 5-year variable, you are losing some buying power going that fixed route versus sticking with the variable route, just due to qualification and how the bank's going to take a look at that. So it is something definitely to keep in mind. But again, it really comes down to what do you need, what can you afford. Obviously, if you need to go variable to get into that property, you don't necessarily have a choice of if you that extra 1% really is kind of that killing factor. There are other ways to be able to get around it. If you are struggling on the A side, there are B options to be to be had and be taken advantage of, that does allow you to have more overall debt and higher debt ratios, more aggressive use of rental income. So there are other ways, and there are, these are the ways that people are going to have to start taking advantage of moving forward as the market starts tightening up in terms of rates and qualifying potentially at higher than that 5.25. It's just finding different ways. There are banks out there that do allow something called a contract rate qualification. So you're not qualifying at that 5.25, you're qualifying at their actual, interest rate that you're going to get on your commitment. Now that commitment rate might be a little bit higher than, the average rates on the market, but if you're qualifying at 3.5% or 4% instead of that 5.25 or above, that might be the saving grace for some people. We have lenders on the B side that can do 35 and even potentially a 40-year AM, depending on where the property is located and what type of property. Taking advantage of those long amortizations, that additional 5 to 10 years compared to a 30-year can be the difference for some people in qualifying. So again, there are options out there that you can take advantage of that are going to be really great solutions for people. But again, it's there. We haven't seen a huge difference in how we're qualifying on the B side for sure. B side right now, you're definitely qualifying 2% above contract rate, so you're above that 5.25%. But on the A side, if you're on variable, you're still qualifying at that 5.25% stress test.
Got it. And again, I'll go back to some basic question that you kind of answered. I want to hear a little bit more in deeper, with this point in time, with the projections of the rates going up, do you guys still recommend variable or fixed for an investor? What's your take in there? Because that's a common question I'm getting even more nowadays. Because usually I used to say just go for variable because you have a lot of flexibility. Generally you're starting with a low interest rate, but now with these rates, the way that is increasing, now I want to get experts advice.
Sure.
What you guys would suggest?
Yeah, I think again it goes back to your investment strategy initially. Like these rates aren't going to change how your investment strategy, and if they are, obviously amend what you're doing. But if your strategy is a BRRRR strategy and you're looking to restructure your debt within the term of the loan, it makes sense to stay variable because the variable term allows you to be able to break with a very minimal penalty of a 3-month interest. Whereas a fixed comes with an interest rate differential cost, which can be very expensive if you break within the start of the term of your loan. So, I would say that the added benefits of having a variable term are still there compared to where fixed is. It's just rates are a little bit higher now, and there's a little bit of variability in the market, which is where the name comes from. It's variability. It has risk associated with it for a reason. The gap between variable and fixed right now is quite large, depending on your relationship to prime rate at the moment. So I believe last time I checked, it was 1.25 to 1.5%, depending on the bank and depending on where you're at. So that's a significant gap right now between fixed and variable. Most investors currently would rather take the gamble because they think it's going to take 2 years to get to that point, and they would rather have the savings over the 2 years before actually having to pay that 4.5% rate on the variable side, with still having the added benefit of flexibility of restructuring your debt if you needed to down the road without penalty. So obviously one of the exit strategies for investors is sell, right? And unfortunately, it's the last strategy, but it's one of the strategies if you had to liquidate quickly. And having that variable term would allow you to be able to do that and kind of not add to your bottom line of having that extra expense to break your loan. So the majority of our investors is still staying variable. It's proven over, if you take a look at 25 years, if you stick with it and stay consistent, you'll save money over time with a variable term.
Yeah, makes sense. Again, love to hear that, because that's kind of what I have in my mind. I haven't changed any of my mortgages from variable because all of my properties except my primary home was the rest everything is variables. it still makes sense to me because I want to have that flexibility. And still, anyways, I'm not close to um, the fixed rate that we have right now. So again, that being said, for investors like me who already own some properties, if the variable rates, or like for example, I want to keep this property for long run, but the variable rate, when I bought it was like it's always like when I got the mortgage, it's like prime minus 1 or prime minus zero point 0.5. It depends on which lender I went with at that time. If it's close to fixed, is it a good time to turn it back into fixed, with the expected, if my goal is to keep it for long run?
Yeah, I mean, if you don't want to touch the equity in the property anymore and that doesn't matter to you, and you want to just kind of lock in your cash flow and hold it for the long time, then if that aligns with your investment strategy, I would say I would advise you to go to a fixed term and kind of wait out the next few years to see what happens. Again, if it has to align with your strategy, and that's what Aaron and I essentially do. Is we don't offer cookie cutter services because it doesn't exist for our clients. Like, you have a very unique situation and needs and wants and requirements for your portfolio, your family, and your goals, and so does somebody else, and it's very different from you and that other person. So these discussions and what we're speaking about right now are the same discussions we have with all of our clients. It's what is your short-term goal, long-term goal, requirements, needs, wants. And then from there, we kind of morph and build these financing solutions around your requirements. So, anybody watching this, I recommend obviously if you're not having these discussions, have them, because these discussions are going to allow you to be able to either be insulated and protected, or move forward when kind of everything simmers down a little bit.
Yeah, I know. I get, I totally agree, because, that's another, that brings up to another question that probably you need to have with your discussion with your mortgage is like, if you already have a good equity in your home sitting right now, your home or investment property, um, people who are planning to keep it for long run, like someone asking in the beginning, is it a good time to refinance, right? So if can I refinance my properties even though I don't want to touch my equity for now, but I want to have the money, access to the money, and invest when I need it?
Yeah, I mean, I think there's a few different ways that you can use that equity. It depending on where your rate is and how far into your term you are. Maybe a full refinance isn't the best option. If you're in a 5-year fixed and you were able to lock in last year, you got 40 years left. You don't want to break that rate. There are other options out there. You could take a look at a private second. And one thing that really, to, I guess, like a forward, it really comes down to what is the overall cost of the entire transaction going to be. If we're taking a look at breaking a mortgage or adding a second mortgage or doing a cross collateralization to use that equity, and in conjunction with a purchase, what method and what combination of products is going to give you the overall cheapest transaction and potentially give you the best option on your current property? If refinancing means you're going from a 1.5% to a 4.5%, maybe that's not the best option. If you're in your first year of a 4-year, maybe you take a look at doing a second mortgage at the time of the transaction. If it's going to be a flip or something like that, and you just need short-term money and you're going to be only in there for 3 to 6 months, that carrying cost, that private second, isn't going to be as exaggerated as it is going to be if you're carrying that for 12 months. And there are some decent private second options out there if you go like an investment company type route, like a MIC route, or if you have a parent or family who gives you family discounts, it's not a bad option. The third option is just cross collateralizing. Again, we have a lot of creative private lenders out there, like Calvert with our flip lenders. They will take a look at cross collateralization. They'll use that equity without having to break that first position mortgage. We can use it to reduce your rate. We can use it to use as down payment, increase your loan to value. And you don't have to break that first position mortgage. There are ways to use that equity without having to break your first. And if it's a cheaper overall option, then that's a win-win. If you don't have to break that and you can keep it on there. So there are other ways to be able to access that equity without having to break that first position if you have a really great rate. Something else to keep in mind too, if you have a fixed rate, there are 2 prepayment penalties on the fixed rate. There is the interest rate differential, but there's also the possibility that you are subject to 3 months of interest. So It takes a look at whatever is greater. So typically, if you're in an increasing market, which we are, and the fixed rates comparatively on what your remaining portion would be on the posted rate is higher than the rate that you have now, you're going to have a negative difference. So let's say you had a 2 and rates are now 4. You can't apply that negative 2%. It has to be a positive difference. In most circumstances, you would actually revert back only to a 3 months interest. So if you're in that position, it might be good to check your commitment, figure out what your prepayment penalties are and what you are going to be subject to, because it may not be that interest rate differential. If it is, we've seen some large ones. It could be 5,000, it could be 10, it could be 20. So, in that situation, if it's going to cost you $15,000, $20,000 to break your mortgage and you're just trying to pull some down payment, maybe it's cheaper just to do a private or do a cross collateralization. So, first thing it's going to just take a look at the commitment, what was outlined, what type of prepayment penalties do you have, what's it going to cost, and what are the cheaper options potentially.
Yeah, that's really good points there. It's good to know about those blanket options. You don't have to break the terms, and what if I lost my track of thoughts here.
It happens to most of us.
Yeah, so that's why I'm trying to put some bullet points here, the questions that I wanted to ask. And also, like, how are you guys seeing about the student rental mortgages? Because that's one challenge I'm being having in last 1-2 months. What's your take in there for someone who is looking to invest in student rental?
If I was going to talk to somebody who hasn't invested yet, who was asking questions about student rentals, I'd be very upfront with them in regards to how difficult it is to get a mortgage for a student rental. Banks don't like it. If you are purchasing a property near a university, the bank doesn't like it. If you have any inkling of a student rental, most banks do not like that financing at all whatsoever. So if you were looking at this, there are some options in the market that are specifically made for this. And essentially what they are is we use a commercial underwriting approach to get these deals done. It's based off of a per door approach. We take a look at the income that's produced on it. We deduct some fixed expenses on the property based off of who actually pays utilities. And that'll give us our net operating income. And then essentially what the bank does is we figure out how self-sustainable is this asset. So based off the revenue, the net revenue, and then the gross annual mortgage payments, how much can it sustain? And then the bank will give you a loan based off of a 1.2 to 1.3 DSR. The more bedrooms you have, the higher the DSR requirements are. But there are some very aggressive conventional lenders out there who do offer it. The majority of them are credit unions. But if somebody tells you you can't get it done, there are definitely ways to get it done. Now, one of the challenges is that they do require leases up front. So if you are buying a property and it isn't currently tenanted and it's like right beside a university, that's going to be a challenge because you don't have any leases in place. So just, if you do look at these types of assets as an investment strategy, just make sure you understand the kind of intricacies around financing for them, because it can be a little more challenging than just investing in a regular investment property.
Yeah. And it's so sensitive that, there are some areas, especially in Windsor, where if you're in a close proximity to the university, lenders just won't even, lend on the property to begin with. So like that's kind of the environment around student rental. Like there are a lot of red flags around there, but like Josh said, there are some specialty products.
Yeah, so probably if my understanding is correct, just be prepared to either have a higher down payment or prepared to get higher interest rates, because when you're going for a commercial type, so the investors has to structure in expect that there will be higher interest rate compared to it's not a regular traditional residential mortgage.
That's correct. Yeah. So usually there is 25% down payment at least. So it's not up to 80%, it's 25. And most of the time, you're looking at a 25-year amortization as well with these banks. There is some sort of acquisition fee if you are using a broker to do this. So understand that this isn't like going to Scotiabank or going to RBC. There is a cost of being able to have somebody acquire this loan for you.
Got it. Yeah, and again, I was hearing for some probably 1 or 2 banks told me that there is a possibility that I can use some gifted funds to buy an investment property. How far is it true? Is it really came into play, or like what's your take in there?
Yeah.
Yeah. There are lenders that do allow you. Scotia does not like it at all on rental properties. They're okay on owner occupied, but there are other banks out there that do allow you to use gifted funds. On the A side, in purchases in general, you are limited to AML sourcing on your down payment. So anything gifted to you does have to come from an immediate family member. So, brother, sister, mom, dad, grandparent, uncles, cousins. You got to have a really, really good reason as to why it's coming from someone who's kind of removed. Definitely nothing coming from friends. There are B-side lenders that do get a little bit more flexible with where you can take your down payments from. On the B side, same rules apply for gifted financing, immediate family members, but you can do unsecured lines of credits, credit cards, HELOCs, as long as you can qualify with the incurred payment. You are able to borrow that debt from a non-traditional type resource. Unlike the A side, there are lenders who do allow you to use a HELOC, but you're not going to be using unsecured or a credit card for the down payment.
Yeah.
But yeah, gifted down payments for rentals, for the most part, it is accepted. Yeah.
But you raised another good point. The unsecured or credit cards. So are there any lenders that would allow those, like other than the A lenders? Of course, I know A lenders don't.
Unsecured and credit cards. I would never advise a client to use unsecured debt or a credit card as a down payment source. Credit cards are 20% plus, and
But someone who is desperate and they want to get in, and that's the only source they have, because that's a common question also I got. Like,
sure.
are
Yeah. So,
there any
yeah,
lenders at all?
there are B lenders out there. If you really needed to use an unsecured line, you could use an unsecured line as long as you could service the debt. Now, the challenge with it is, if you're on the B side, you probably have not problems, but you probably have issues qualifying. And if you're servicing that amount of money, so usually down payment is decently large, you need 20%. So if you're scrounging for money, let's say 10%, or like $10,000, we have to use 3% of the outstanding balance as your monthly payment. So usually like 99% of the time, it doesn't work borrowing that type of debt to be able to purchase an asset, just because the monthly carrying cost on it puts your ratios over where it needs to be anyways.
Mm-hmm. Yeah, but again, like I said, it's a unique circumstances. Of course, guys, if you're watching this live,
It
and I
happens.
see there are 30 plus people. If you have any questions, let us know in the comments. Again, this is a common question. This is not a typical solution for your situation. Might not be a typical solution, right? But I've been asked in the past, like, hey, I have a really good deal, and I don't have money, but I have this line of credit, I have this access, blah blah blah. But good to know there are solutions. Again, that's exactly why I always recommend talk to a mortgage specialist, because when you're talking to them, and especially who are investors focused, that's one reason I like to work with investor focused specialized person who understand all these strategies, understand your needs, and find solutions for your needs. So let's take out a question here. Can a property owner under corporation get refi without PG? I don't know what PG means.
Personal guarantee.
Personal guarantee. Okay. So if so, how long does it take?
So it depends on what type of property we're talking about. On the residential side, no, you cannot qualify solely on a property solely on a corporation. Now, what you could do if you own that corporation and it's generating income for you, if it's your business, professional corp, you can do a bank stated income and use the revenue coming in to help you qualify, but you cannot qualify based solely on that corporation with no personal guarantee. Now, when you get on the commercial side, it's a little bit different. If you had, a McDonald's and it was just cash cowing and the balance sheets were angelic, yeah, you could qualify based on the corporation without probably needing a personal guarantee. But I have yet to have a client who has a corporation that's pumping out that much income and has that great of a balance sheet that they haven't asked for the personal guarantee. 199.99% of the time, they're asking for some sort of PPSA. Is it possible? Sure. But we're talking about big corporations, REITs, stuff like that, where it's, you're making.
You're in private banking with RBC. Like you're not talking to a broker if you're.
Actually, he's saying that in the next comment, multi-res for a multifamily.
No. Yeah. So essentially what happens is if you're a director in a corporation, over 20% ownership of that corporation, you have to personally guarantee. There isn't a way for you to get it to essentially not sign. Now, that being said, if there are multiple people on a corporation, let's say yourself and 3 other partners, and you owned less than 20% of that corporation, and you were like a shareholder, you could be on the corporation without necessarily needing to personally guarantee the loan. But if you are the only director owner of the corporation, there's no way for you to get away with not personally signing. Now, that being said, you also can't be the one who's bringing all the money to the deal and own like 18% of the corporation, because the bank can see through it as well. They need to obviously take a look at the entire structure of the deal. But there are ways for you to be on a corporation without necessarily needing to personally guarantee a loan.
What if the corporation has a lot of active income other than the passive income? Again, and I don't know. It's my question. Probably I have a corporation that has a lot of active income, and if I want, like, that has more than 2 years, if I want to buy the property on that same corporation,
you probably still need to personally guarantee the loan. I mean, they might be able to take some of the income from your 2-year average if it's consistent and you're doing a really good job. But I've yet to see somebody use a corporation and not personally guarantee the loan.
Yeah, probably this question is for Erin.
What are you using?
Just my fingers, buddy.
Just the fingers.
That's a good one. Navdeep, another question here. Going forward, is there a risk that variable rates exceed 3.25, thereby reducing borrower qualification based on the stress test limit of 5.25?
Is there a risk? Yes. I mean, there's always a risk.
It's going to happen in June.
They're talking right now, I think, another 1.25 point potentially by the end. Well, no real end line on it, but yeah, I mean, there's definitely a strong possibility that it gets up to that point. Now, at that 3.25, you are still qualifying at the same rate. You would really start to see the first true reduction in power once you get to that 4%. Once you're a full half a basis point, that was kind of confusing, but a half a basis point higher than the stress test, that's when you're really going to start to see. So once you get to that 4%, and you're qualifying at 6%, that's probably when you're going to start to see the true reduction in purchasing power. But again, there's ways to get around that. 35, 40-year AMs, you get on the B side, you start using higher debt ratios, more competitive rental income usage. There are ways to kind of mitigate that, but yeah.
I also think.
Sorry, go ahead, Josh.
I was gonna say, like forward thinking. Like, I honestly think that the government is most likely at some point going to have to kibosh the stress test. It doesn't make sense anymore. Once you start to have prime rates above where the qualification is, it doesn't make sense. I mean, you're gonna have fixed rates above 5.25 probably in the next 2 or 3 months. It's kind of useless at that point. So I think to help people get into the market, they're probably going to kibosh the stress test, which will allow you to qualify contract rate, which will definitely at least give you a little bit of borrowing power. But that's just kind of my thoughts on what's going to happen next.
Yeah, makes sense. So probably I lost my question again. Yeah, so let's get to this question here. Tarun got you guys are the best. So thank you guys for being here. Looks like he's watching your channel as well. So the recommendations for experienced MCAP. Oops, sorry, my bad there. Experienced investors, MCAP, credit union, or First Nation has a lender in Windsor.
So credit unions aren't really going to fall. So I guess it depends on. Credit unions have 2 sources that you can submit a deal in. They have your retail side, which is similar to MCAP, and what I'm assuming you meant by First National. And then they have the commercial side. I wouldn't necessarily compare the commercial to the retail, but honestly, one of the most competitive lenders is going to be Scotia in terms of rental. They give you the best rental usage, so they use what we call an offset and not necessarily an add back. So the offset actually takes your rental income, which is the allotment's going to be 50% with Scotia. So let's say you have a $2,000 lease, they're going to take that $1,000 a month, and they're actually going to reduce your property expenses by that $1,000. And then further on that, they actually don't take into consideration your property tax, condo fees, and heating costs. So we're really just taking a look at 50% of your lease and your principal and interest payments. So the rule of thumb of Scotia is as long as your lease is 2 times your mortgage payment, you can effectively remove the debt servicing and cost of that property from your application. And if your lease is above that 2 times, then you're actually going to get a little bit of income added back onto your application to help qualify. So Scotia is by far, definitely the best A lender that we'd be using to get it done. MCAP and First National, they are good lenders. They do have great rates, they have great products. But in terms of what lender is going to give you the most amount of qualifying power, it's definitely going to be Scotia.
For sure. In regards to rate wise, though, usually I'd say First National has a little bit more of a competitive rate than what MCAP has, and the credit union's qualified contract rate. So they all have their advantages. It really just depends on your situation, what you need, what you want.
Yeah, that's good to know actually. So I was also hearing the same thing about Scotia, that they are pretty flexible with the investors nowadays. Actually,
then we'll tell you exactly what you need.
Going back to my question that I lost in the track, you're saying that one of the best way to increase your qualification by taking a longer amortization, more than 30 years. Is that possible for even residential?
Yep. Yeah, so it really is for residential. There are lenders out there. It's predominantly B lenders that would allow you to do it, but they do offer 35 and 40-year AMs. On the multi-unit side, in the commercial space, there is the CMHC option that does have the ability to extend your amortization up to 50 years, depending on whichever 2 products you are able to qualify for. So there are options on both, but on the residential side, there are more options available in terms of increasing your amortization. It is a B lender, so there does come with some increased costs. The interest rate right now on a B lender, a 1-year rate is you're 4.8%. Majority across the board. A 2-year, you're 5.15, and a 3-year, you're 5.35, 5.5. Home trust is like 6% right now on a 3-year. So the rates are higher. There are some fees involved, but if you're looking for a solution to get into the market, and ride it out until we hopefully recover a little bit, the B lenders are there and they are a great tool.
Yeah, makes sense. Good to know actually. I didn't know that residential you can extend more than 30 years. So what's your take on the increasing rates if interests and falling prices in GTA? So
you haven't been watching any of our live stream.
They're correlated.
Yeah, I would say that they're definitely correlated. I think that, so there's a graph. I don't know if I can pull it. I don't know if I can pull it up, but essentially as interest rates increase, usually you see a correction in the market. We are probably coming off one of the hottest spouts of real estate in history. There's a lot of people who overbought, a lot of people who bought out of fear. You're seeing certain places in the GTA have already lost 30% of the value from the top back in February. I think you're going to see a little bit of normalcy in the market. You're going to see probably a softening in secondary markets that aren't as strong. They got overbought. You're going to see probably the core market stay decently strong. I think you might see, honestly, a sell-off of condominiums just because of the type of investors that own those condos. The majority of people who own condos in Toronto, they are either cash flow negative or very, very close to it. When you have somebody who owns 10 or 20 of them and variable rates start going up and you're underwater, I think you might see a little bit of a discount on those. Other than that, it's definitely correlated. Interest rates are going to go up. I think you're going to continue to see valuations maybe stay stagnant or decrease slightly still. And we're already at 20%. And we've already seen a decent correction for the majority of Southwestern Ontario. So I would like to think I'm a hopeless optimist and would like to think that we're not going to see any further dips in the market. But I think we just move forward and hopefully things work out.
And it's undulating, right? So, again, you go back to 2009, there was definitely decreases. 2016, there was a bubble, if you want to call it a bubble. There was a decrease, but the market undulates. There's dips, there's rises. It's been consistent. It's always been like that. It's not going to be so much about like housing prices are going to go down, but it's there's going to be a change in strategy and how people are investing and how they're buying. Are flips going to be as strong as they were over the last 2 years? No, you're probably gonna have to pick your targets a little bit better. Definitely try to focus on major city centers. The more rural that you get, the more you're going to start to feel that plateau or that lessening in the market and in offers. But it's going to come back up, unless this is the one time it doesn't. But like people have been calling for a housing market crash for years and years and years. And there's dips, there's rises, there's dips, there's rises. We just saw one of the hottest markets that we've ever seen, and that's come after 2009. It's come after 2016. So, it moves. If you get into a market and you assume that you're going to have forever positive increase in appreciation, it's a very ignorant thought. There's going to be times like this because the housing market doesn't just rely on the housing market. It relies on the economy, relies on immigration, printing of money. How are things going? You take a look at Canada and how we produce our GDP. And how the government likes to spend our money. There's other factors that are going to have an impact. So to assume you're going to be able to buy and forever have increased appreciation is not the right mindset to have. So
completely agree. And I also think that we're not sitting here telling you all to be scared of the interest rate hikes. I think it's a lot more that goes into what's happening with our economy right now. There is still a massive need for people who need homes. We are having a huge amount of immigration coming into our country. We have the population the size of Burlington literally coming to our country in the next 3 years with places to live.
1.2 million.
It's unbelievable the amount of people that are about to come into our country, and our government can't figure out a way to be able to actually house these people. So the demand is still going to be there.
Aren't enough rental units.
Yeah, so. and I think that one thing to consider when people are like things are going to crash, understanding that the actual value of the things that it costs to build your home have increased. That 2x4 in your house is $10 now. Like it's, you might see a decrease in value, but the actual cost of building homes is drastically increased. So I still think there's demand. The value of these homes have intrinsic value to them. I think that you're just seeing kind of rational thinking take over and the government having to curb inflation. And these are all natural things that need to happen. I think there's going to be a little pain along the way, and some people who are over leveraged are going to be in tough situations. But you can think of this now. I don't think we're going to feel real pain until later in August and October. So if you have the opportunity to have some sort of foresight, do it now. And plan it, because we're not going to get away from it.
Yeah, no, I think I feel the same way, because it's we have seen such a high increase in the market, the prices. So probably it's a time to correction, and the corrections has happened over the years, multiple times. So when the corrections happen, probably you might be able to get some discounted properties. So, and that's one of the reason why I know you guys do the same thing, and pretty much from me and my team, we focus on more in cash flow properties. When you have a cash flowing property, and if you have a decent cash flow, now even if you have to bear another extra $200, $300, $400 expense, you're still fine. If you're holding a property for 5, 10, 20 years, over the period, generally we know with the inflation, with the population growth, with the all the elements, the mortgage pay down every month by your tenants, over the period you will make a decent returns on your money, instead of keeping the money sitting in the bank. So yeah, that's because there was another question, someone asking again, is it do you think we should wait because of the current market trends?
Listen, I mean, there's still deals out there to be found, right?
Yeah.
If you aren't actively looking, you're definitely not going to find any deals. If you're sitting at home and you're just waiting for 2 months to go by, you're missing out on. There are deals out there. There's still deals coming across our desk. He's still out there. He's still helping his clients. The market is still active. So if you stop looking, you're never going to find any deals. Due diligence is going to have to be higher. You're going to have to run the numbers more conservatively. Put some further stress tests in place. What are you comfortable making cash flow? What are you not comfortable? Where does that need to be? there's still deals to be found on the MLS and off on private sales. So, reaching out to your network, being more involved with your network, expanding your network is going to be the way that you're going to start to find these deals. And I definitely wouldn't recommend shutting off your computer and just waiting for the next 2 months to go by and then flipping it back on, because you're going to lose out on deals for sure. So
Yeah, I love that. That's how I feel, because when everyone is fearful, probably you can get a good deal, especially if you know the market value of the property. Let's say it's a 500,000, but you're getting the deal for like 350. Clearly you already got the property for a pretty good discount. Then what's the point even waiting? You can just flip that, or wholesale, or contract, or do some renovations and rent it out, or you have multiple options there to do it. So yeah, I totally agree.
Well, and think of it this way too. If you're having this thought, so are thousands of other investors. And if 1,000 other investors all turn their computers off for 2 months, it's 1,000 less people buying and looking at deals. So, moving forward, as everyone starts to pull back away and second guessing and deer in the headlights, that's going to be your time to go in, and you're probably going to have less competition taking a look at these deals, because these people are going to be on reserve and are second guessing and are taking more time to think about it. So, now is not going to be a time necessarily to sit back and wait, but maybe a time to take more action and be putting in more offers, because you're not going to get the 35, 20, 15 offers on properties like you were getting in the last year and a half. You're going to get 2, 5, maybe even none. I know for myself, when I put my offer in a month ago, I was one of 2 offers. I had 2 other clients that just bought homes. They were one of 2 and one of 3. So, the offers on properties are definitely going down. And there's going to be more people like yourself second guessing buying at this time. And the more people who second guess, the better of an opportunity you're going to have for you to go out and get a deal at a much better price. So
yeah, I love that advice. Just do a little bit more heavy due diligence and take a lot more actions, so you'll be able to make money no matter what the market condition is. And someone is asking, do you guys have access to lenders in Calgary or out west in general?
We do, yep. So we own a Dominion Lending Center franchise, which gives us access to lenders all across Canada. So we can not Saskatchewan, yeah, or
Perfect.
New Brunswick.
No, I think we're good. New Brunswick,
yeah.
Saskatchewan on the residential side is the one area we can't.
But we can definitely help you facilitate your transaction out west if that is somewhere.
Perfect. And I have on the screen, you guys can see, Josh and Erin's Instagram page there. So reach out to them on Instagram, and if you have a number, if you can leave it in the chat box, or if there is any office number or email address that people can reach out to you guys, that would be fantastic. There is one more question here, and also I have one question, and then I know you guys, it's already 8 o'clock. If you guys don't mind, just 2 more minutes, and we'll wrap it up tonight. Definitely, it's a right time to discuss all this mortgage related topics, because thank you so much for being here. It's a lot of information that even I personally learned, so many things that that I didn't know before. So thank you for being here. Navdeep asking this question. These alternatives ways you mentioned to get around the stress test limitations, do they all involve a minimum of 20% down?
Yes. Yeah.
They are all uninsured mortgage products. So when you're talking about alternative lending, that is essentially at a minimum 20% down. So you would have to have at least 20% equity in a property, or 20% as a down payment to be able to utilize those solutions.
So what if I have the 10% from a private lender or from a friend of mine, where I say they're my private lender? Is that possible? Like creative ideas?
No. For the 20%.
No, not for the down payment. No, like no. Conventional lending. So if you have a commercial side, we can start debt servicing private debt as long as the debt servicing works. But conventional lending, you're not allowed to use secondary financing when you're looking to restructure debt. A regular A lender won't allow you to do it, or even a B lender.
Yeah, makes yeah, unless if I lie to you, I have my money coming from my parents. It's my gifted funds. So that's where we can say a disclaimer here. We are just a random guys talking on YouTube. Please talk to your
I would say that if you're gonna get a gift, you got to get it from a direct family member with a gift letter and history. to back it
You
up.
just ask your friend to transfer to your parents and ask your parents.
I know what you're talking
I
about.
would say you probably got to get a gift letter, and your parents got to give it to you. You need the history possibly if they ask.
Yep. So one question that I wanted to ask, what are some precautions that a lot of first-time home buyers, first-time investors who are like been waiting, they want to get in because now they see because last year there a lot of people have couldn't buy a property, but now they are seeing discounted prices, so they want to get in. What are some precautions that you would suggest with this, the rate changes?
Just run your numbers. Just you're going to know what you feel comfortable affording and not affording. And in a market of uncertainty with rates, you don't want to be in a position where you get into a variable rate and you get in at, if you're a first time buyer, you're 275 right now on uninsured. It's going to go up. If you're uncomfortable at 4%, then you got to be able to manage what that mortgage payment is going to be. If you're at 500,000 and you don't like where your mortgage payment is going to be, unfortunately, you're going to have to take a look at something lower. Like it's just going to be understanding where your stops are. Like what are your red lights, and where can you afford and what can you not afford, and not take less risk, but just know the numbers, do more due diligence, figure out what you're comfortable with, talk to professionals, like run the scenarios, figure out what it looks like, do the due diligence before time, and really have an understanding of all the numbers.
Is there any way that they can get approvals before even like writing offers so that they can hold their rates, even if how long does generally that pre-approval rate will be holding?
120 days.
So they can hold their rate, whatever the rate.
Yeah. So it's important to understand that they put a buffer on the contract rate. So say, for example, they're offering you 4.39 today on a 5-year fixed rate. They're probably going to put your pre-approval rate at like 4.79 or 4.8%, because they're not going to guarantee today's rate, but they're going to, guarantee that if you go above a certain level of rate, then, they'll guarantee that rate. So, we have this often essentially where, people will come and say, well, that's not what the rate is right now. Well, the bank doesn't give you contract rate and guarantee the rate today. They add a buffer to it. So it is a great idea, especially if you are looking to go buy a house right now, because interest rates are moving so much, definitely go get pre-approved. It'll allow you to at least be insulated slightly from the increasing interest rate environment.
And how about the pre-constructions that, for example, I have a pre-construction that is pending closing in January next year. Can I lock up my rate now?
You can go with it. So unfortunately, the broker channel doesn't give out approvals that far. I think we only have 120-day approval login rate.
There's one that gives 1 year.
Maybe right? One. Yeah, maybe one lender that gives, I think Scotia maybe gives like a 1 year rate, but you can go. So depending on who you're banking with, RBC will give you a rate. If you like have a 3-year pre-con, you can actually go get approved now to go close on that deal later on. So there are a handful of lenders out there who could offer you your approval.
Got it. One last question, I promise here. How to lowball a listing price to put up an offer? Probably it's a question for me, and maybe I would love to hear your thoughts as well.
How to lowball? Put it as low as possible. I think you're moving forward. You're going to see house listings priced more closer to the mark that a seller wants to get. You're not going to see as much of the list at 699. I want 9, because I don't think people are going to be as casual with money. So I think if you want, if someone wants 800 for a house, you're going to have to put it around 750, 775. I don't think you're going to get the 200,000s over anymore. People just aren't going to want to spend that much money. So.
Or crazy thought, you could list it for what it's worth, and maybe see if someone wants to buy it.
Yeah. Again, if my understanding is correct, he's asking about to buy a property that is listed for X price. So lowballing on that X price. Hey, if the property been on the market for more than a week, they don't have an offer date, go lowball. Because go write an offer. What's the worst thing could happen? They would reject your offer.
And again, there's going to be tons of other people who are sitting at home thinking it's too crazy to put offers in right now. So
exactly, and who knows, because especially in this kind of market situations where writing those lowball offers actually makes sense. If they're in a desperate, maybe out of 10, 9 people will reject your offer, but one person might look at, oh, I'm in a need. And I was surprised this month. Like my team, we have helped like over close to 20 people on investment properties. From those, like 3 or 4 property prices, I was super surprised. We got a duplex for 400,000. That was in a very livable condition, side by side. I'm like, what? Because if it's just 2 months ago, that property would have sold for 550, and this client, he took an initiation to write that offer. Whatever the price is, he wrote an offer, and surprisingly he got it. Like, so it's definitely doable. I would strongly recommend go write the offer. So guys, thank you so much. One last question. Sorry.
One last question. All right, one more.
No.
So this is the last one. Final. No more questions. Okay. So
Unless she's on title with you, she's not going to be able to give you down payment.
Or if you guys are common law and you guys claim your taxes as common law, then possibly you might get away with it. But no, you cannot use your girlfriend's down payment source unless she's on title.
Okay, perfect, guys. Thank you so much. And who everyone watching, if you have any questions, more questions about mortgage, reach out to them on Instagram. And also, let me see if you have a phone number here. So reach out on Instagram, DM them. I'm pretty sure there is a info there on how, and they share lot of good the mortgage specific related tips, strategies, different things that you definitely need to know on a regular basis, because the market ever changing. So follow them. Josh and Erin, thank you so much for giving your time. I know extra on top of 1 hour extra 10 minutes. So I appreciate a lot.
Thank you very much.
Yeah, take care, guys.
Yeah.